I'm Peter Reznicek from ShadowTrader.net, and this is the weekend edition. Lots to talk about this week, starting with the enormous hammer candle that has been printed on the major averages for the month of April. It truly is epic, and I think it bodes pretty well for the buyers, and at the very least, it bodes pretty poorly for those bears who think that we're going to revisit the recent lows anytime soon. Beyond that, those major averages have also now crossed a 61.8% fib retracement from high to low. That's, of course, very, very key since it's the most important fib number, and it generally leads to 100% retracement at some time when you close bars above that 61.8. So we're going to talk about that as well. One of my subscribers came up with a really creative idea in Google for this week in options. So that's going to be our Should I Do This Trade segment today. And I've also got a #1 draft pick for the music lovers out there. So hint, see if you can guess the ticker before I show it to you later in the show. All right, all that and lots more. Less talk, more charts. Let's get into it. Let's kick off a little week in review so we can get an idea of what went on with the 11 sectors of the S&P major averages and also a few other instruments that are, of course, very, very important. You can see, of course, all green pretty much across the board. Solid advances on the majors. S&P about 3, NASDAQ about 3.5, Russell also about 3. Not too much in the way of outliers in the 11 sectors in that everything was up pretty solidly, but I am looking at this energy. Crude has lost the $60 handle as of late, and I think there could be a play coming up in energy, kind of like a bottom fishing thing. So you're going to want to be watching for some of those components in XLE next week, maybe week after. The lower oil goes, more than likely you're going to get some sort of rebound play in some of those stocks since they've been showing a lot of relative weakness. And as we know, oil is relatively elastic, right? Like it's going to come down and bounce back up, and it's going to take those stocks with them. So I'm going to be watching for that. Bonds continue just to be a malaise. I said this last week. I'm going to say it again. This is not a trade that anybody should be in. Short-term, long-term, whatever. It's not a haven. It's not happening. I don't think anybody cares. I think it's just not happening. So forget about that. You had an uptick in yield. VIX continues to collapse. Gold actually had a pullback this week, and I've been talking about that 3,200 buy. I've actually pulled my orders from that. Just because I think there may be a little bit more downside to go. The dollar's been kind of strengthening up a little bit, might move a little bit further. Somewhere between 3,200 and 3,100 is going to be a strong buy point. I totally understand that that's a huge range and it's not much of a trade call. I totally get that, but you just got to pick your spots somewhere in there. I'm going to be watching very, very closely for the next leg higher. I'm just not sure if it's going to start at that 3,200 or if it's going to start a little bit lower, but I will be watching very, very closely. Oil, as I already discussed, hand in hand with the XLE, oil was down almost 8% from the week. This is measured from Monday's open to Friday's close. And Bitcoin had a great week, way up deep into the 90s now, close to 100. I think we're at about 97K now. So Bitcoin is obviously moving with the market bullish. I've been saying this for a while that I don't see it as a haven asset or anything that's going to act defensively. It generally moves with equities, and obviously with the bullishness in stocks, you get bullishness in Bitcoin as well. All right, so that's our week in review. Looking back just a little bit, and now for the rest of the program, we are going to look forward. So let's get into the charts in our What's Really Going On segment. Okay, what's really going on? This is where we get into the TA on the majors. This is what I feel is the meat of this program, so to speak, because the charts really tell us what's really going on, especially in an environment right now where we've got enormous headline risk, right? We constantly see futures reacting to whether or not China's coming to the table for negotiations. All sorts of things like that keep coming at us. And it's a very relatively, news-driven market at the moment, but at the end of the day, the charts really tell the tale as to where price action was. And we're going to start off with this enormous monthly hammer here on the monthly charts. This is the month of April. As you can see, it is epic. Really one of the largest downside shadows I think that I've ever seen in the S&P. I mean, on a percentage basis, I haven't calculated it, but it's huge. I mean, you can clearly see that if this is 5,500 and this is 5,000, well, then just this piece here is 10%, and it's obviously more than that. So it's really, really, really huge in that sense. The NASDAQ 100 has the exact same bar, right? We don't need to guess on that. You can just imagine that it's the same exact bar. I'll just make it bigger for you, just show you that. I'll take off these for now. We're going to talk about that in a second in terms of fibs. So same thing in the NASDAQ 100. And going back, before we get off these monthlies, I just wanted to point out that This really hasn't happened in some time. As we go backwards, what you want to look at is when you have large shadows like this, it's relatively rare on the monthly charts. Remember, this doesn't necessarily work on smaller time frames. I've said this many, many times that a lot of newer traders get sucked into this hammer thing, you know, where they see this bar on a 5-minute or something and they think, okay, that's it, it's definitely going to work. And it often doesn't, or it becomes much harder to trade than they think. But on the monthly charts, as you go out into the longer time frames, you will see historically that large shadows tend to hold, and it's relatively rare that you move back down below the low of the shadow. So just going back here, there's not many large shadows, although maybe this bar has a decent sized shadow. Here, these were violated. You had some downside shadows. Those actually were violated. Here's a shadow right here on the monthly that was pretty big that set up a larger move to the upside. And more importantly, I wanted to look at examples from like when there was real downward movement, like in the global financial crisis in here. We started to come off right around here in late 07. And as everybody knows, we bottomed in March 09. And this one was kind of interesting in that it did have the monthly hammer that was actually violated a couple of months later. So that is actually interesting. You want to keep that in mind just as kind of perspective. And then coming into here, which is like internet bubble raging in here and then coming down. Here, the hammers were actually taken out for a good piece, right? This setup here, you made somewhat of a rally, actually came back down. Here, set up a rally, went sideways for a few months, came back down. And then here finally is where the larger rally kicked off in earnest because the bar wasn't really violated. It was actually more of a triple bottom, right? The prices couldn't get down below that 800 level, and that then sparked a pretty large rally. So there is history here that does show. Here's another one, by the way, down here, 09 low. I guess we already talked about that, but there is history that these have been violated. Now, can it happen with one of this size? I don't know. I think we'd have to have some seriously bearish news, be spinning the market and the economy off into recession, which certainly could still happen. Believe me, I'm not, I'm much more bullish on the market than I am on the economy, but also, as you know, I'm a very short-term trader, so I take everything one day at a time, maximum of like 1 week at a time, so it doesn't really matter to me, in the bigger picture, how this plays out. I just want movement so I can make money off of movement. But I like to think of these things, historically, I keep them sort of in mind. These are all very, very important signposts to remember. So pay attention to this monthly hammer. Again, my take is it's going to be quite difficult for the markets to get back down through it. Of course, anything can happen, but in general, that's not how TA works, at least not in the next month right away, right? We may have some sideways action here that may come like this, and then we get some bad news and it sputters, and we break the low and make a new low later, but generally in the next month, it's relatively rare that you would do it right away. Okay, that being said, let's move over to the dailies. I want to point something out here in terms of how much we've retraced in the move from the high to low, because it has already cracked the 61.8, which is really, really important. So if I take the fib tool and I go like this, look at where we closed on Friday. Thursday's action went above a little bit, and Friday's action closed really far above the 61.8. Now, this doesn't mean guaranteed that we're going back to the highs, but my take on it, the way that I always trade, is that whenever I see a 61% retracement, I feel that the odds are then really, really increasing for the 100%. The odds have just increased greatly that we are actually going to go all the way. And again, we've got a long way to go. That's going to take a lot of time, but over time, that's generally how things work. Once you do not reject at a 61.8% retracement, you will probably move forward. Now, how do I think this is actually going to play out? To be honest with you, I think that this area here is a little bit of congestion, and it's not going to be that easy to chop through. So we may be targeting in like the week to come right in here to this 5,800 level, which would make sense given that it's a large round number, but it's also this prior peak. And then from there, I'm actually expecting a little bit of chop. I'm actually expecting a pullback that's going to kind of fill in some of this area and create this inverted head and shoulders right here. And in order for those pullbacks to be viable, it's real simple. All I have to do is just make sure that these levels here aren't violated. So for instance, like I would probably be looking for this pullback low right here to not be violated, right around this like 54.50 level. So any price action within here, to me, is kind of like a sell put buy calls type of situation in here as I get the pullback. The pullback that comes, you should look at it as a gift because it will be an opportunity to sell puts, buy calls, and put something on, risk reversal or whatever in the up direction, right? Because unless you lose that, things are still bullish. Notice also that on the daily chart over the course of this week, we got the pinch, as I call it. The pinch is when the faster moving average, moves through the slower. I only use 2. I'm a huge believer in the 8 and the 21 because they're both in the fib sequence and they are exponential. These are the fibs that I use exclusively. The moving averages, not fibs, that I use exclusively. And getting a pinch is important because notice that when we got a pinch here, it set up a move that stayed to the downside for quite some time. Notice that even when we had little counter trend rallies here, the 8 remained below the 21. It was never able to pinch. And then finally, boom, right here, it pinches to the upside. So it is a relatively strong signal in terms of that. So watch for that. That's basically how I think things are going to play out. Let's check out the TA real quick in the NDX just to make sure we've got the same fib coming off the high right here. Same exact situation, right? Where Thursday got close and the S&P had actually crossed it on Thursday, so it was a little bit stronger. But you do have the full kind of violation of that level. And the NASDAQ, interestingly enough, is closer to this area right here. So we got a lot going on still with earnings and whatnot, but I would expect there's potential for the NDX to pull back here a little bit as it gets to that level. If it gets to that level ahead of the S&P, then that might be it for the S&P in the short term. And like I was saying, though, there's probably some chance that you fill in some of this area, at least retest that 8 EMA, etc., coming down a bit, to kind of build out that right shoulder of the inverted head and shoulders pattern. And one last chart before I leave this segment. I wanted to show you the Russell here just on the daily to show you how much weaker it is. And this actually makes sense because what's happening right now is that there's a lot of sort of disconnect between whether or not the Fed is actually going to do something this year. We're going to get into a Fed Watch segment a little bit later in the show, and I'm going to talk a little bit more in depth about what our odds are for cut next week at the meeting and again in June, and a couple fundamental things that are around that. And these small cap companies, they need lower interest rates in order to rally. That's a fact. They are heavily indebted, many of them. And as you know, kind of like utilities that are heavily indebted, they need lower rates, and that would make them rally. And you can see that this is playing out in the market perfectly because we just talked about the S&P and the NASDAQ breaching the 61.8, which would be all the way up here. And look at the relative weakness in the Russell. It's still here. So I think these are kind of waiting for a little bit of a rate cut action. I wouldn't do anything in this space here unless I saw a trend line break, which is a ways to go. That's here. And there's just a short-term trend line break here. But really the main one is what matters. You have to get all the way to here just to break trend. And that also is in sharp contrast to what's going on like in the S&P, right? Where we know that if we use by that same metric of just starting at the top, connecting highs, we've clearly broken trend, which is very, very important. I've been talking about this for a little while now that, right, we're no longer in a downtrend. You can't call it a downtrend anymore when that trend line breaks, but that hasn't happened yet in the Russell. So just keep that in mind. That may be a trade that you may want to have on your radar later when the market starts telegraphing that there actually will be a rate cut at the next meeting, although it's not doing that right now. You may see the Russell start to rally, and you may want to do something in IWM or some of those small cap names. Okay, time now to get into a little of should I do this trade? This is a segment that we do sometimes where I solicit ideas from our trading rooms. This one comes from the weekly options room, which I run. And I basically ask subscribers to give me a trade idea for the next week's expiry. And then I judge those ideas. And if I find an idea that I like, or if it has some educational merit and I can show you the reasons that I don't like it, I could choose that as well. But in this one, I did like it. And this week we get this Google idea from a gentleman named Andrew from my room. And what did he want to do? He said that we should initiate a ratio spread on the upside. So sell means that you sell to open, but that is a bullish trade on the call side, because when you sell a ratio, you start with the long option first and the short options in the back, as opposed to a back spread, which is short options in the front and long in the back. There is no such thing as a back ratio. It's either back spread or ratio spread. But in this case, It is initiating the ratio spread in Google for next week, and you can see here the strikes are 165, 172.50, and paying a 64-cent debit for it. You know that it's a debit because it's got that little negative number right there, and you're starting with a sell. So when you're selling for a negative number, that means a debit. And in order to pay for the trade, selling some naked puts on the downside at the 150 level, getting about 42 cents for that. So right off the bat, the first thing you have to notice about this trade, which is one of the reasons that I like it, is that it is cost neutral. In fact, it's a little bit of a credit, right? If you initiate this trade here for 64 cents, and you initiate this trade here for 0.42 times 2, well, you know that you're getting 84, and 84 cents is obviously a lot more than 64 cents, so you've got a net credit of 20 cents. So you're starting this trade off with a credit, which I like, but in general, there is risk with that, right? Don't just assume that just because you start a trade off with a credit that it's better than starting a trade off with a debit. All trades have risk. The question is, where on the charts does that risk reside? And that's what we're going to look at right now to see why I think this is a good trade. So moving over to, let's start with the chart here, then I'll show you the position. But moving over to Google here, the idea was that there would be potential for a rally moving up to about this 170 area. And you can see how Andrew chose the 172.50 strike to be short. I think that was chosen very, very wisely, because look at where this resistance is right here. It's actually right at that 172.50-ish area. It's very, very close to that area. Look at the high of this bar. The high of that bar is 170.63. So it makes perfect sense to set up the ratio spread with the short strikes, targeting an area where there is resistance ahead of us. I love that. That generally is my MO. This is how I trade in the weekly options room. I try to do everything I can to always trade without debit so that if the stock doesn't go anywhere, I don't lose any money. And I'm always looking for that next inflection point ahead where I can set up a trade that has short strikes at that level with long strikes in front of it, so I can be what I call net short. And this is a perfect example of where Andrew is going net short, because on that call side, he is long less contracts here at the lower strike and short more contracts there at the upper strike. And it's also in a ratio of 1/3. So it's long kind of 1 here and short 3 over here. Now, if you recall, the other part of the trade was to be short 150 puts. And why does this make sense? I think it makes a lot of sense because the technicals tell us that the odds probably don't favor a move below the 150. You've got trend line here and you've got trend line here. You would have to violate both of those trend lines here and here just to get anywhere near this 150 here. So on a short-term basis, given that this is a May 9th expiry, I like that a lot in terms of the trade of being a short at the 150 level. Let me just show you exactly what this looks like in a real account. This is the trade right here. Not too big size for me here since it wasn't my idea, but I do like it. But you can see this is the trade. And one thing that should jump out at you right away is that Google has already advanced, right? Trade is already in profit. But there's one thing here that only I think a very sharp eye would notice, which is what makes this trade so great. And that is this. If you recall, the trade is set up as a +1 -3. Look at the ratio here. So it's 5 long, 15 short here, 165, 172. When the trade was put on, these 172s were trading for 28 cents. Since then, the stock has advanced. We know that because look at what happened here. This was only $1.59. Now it's well over $2. But what has happened to your shorts? How much have your shorts appreciated in the rally? None. They've actually depreciated. So you're actually making money on the short side and on the long side because of this structure. And that works really well because the structure is wide. There's meaning that there's plenty of room between the 165 and the 172.50. And just given where that 172.50 is and when it was initiated time-wise in terms of the timeline of, from start to May 9th, it also helps as well. So you can see that the top strike that you're short of has actually already contracted, which is fantastic. And then obviously because we've rallied, the short puts have contracted as well, which is only helping the trade. You can see that those were initiated here at 37 cents and they're now trading for 14. So I absolutely love this idea and I think it makes a lot of sense. Andrew is going to receive a free 1 month credit to his subscription. He's already a subscriber, but I'm going to give him a month free because I did use his idea on the show. So I'm excited for that. So congratulations to Andrew. If anybody wants to learn more about this style of trade, the way that we use complex spreads, the way that we move risk from one side of the chart to the other, we call that risk reversal, right? All of these sort of complex things that we do in the weekly options room so that we can trade without debit and we can set ourselves up to break even basically if the trade goes nowhere. I'd love to teach it to you. We got a big group over there. Things are going really well for us, and I'm really excited all the time about the stuff that we're doing there. Lots of new people have been coming in as of late. We've been getting a lot of great feedback. If you want to join us, the link is in the Chiron below, shadowtrader.net/options. It is also down in the description of this video. Remember, we always offer a $7 one-week trial to all of our rooms, be it the weekly options room or the live trading suite. And as always with Shadow Trader, one-click cancel, no BS. You don't need to call us, you need to email, none of that nonsense. If you find out it's not for you, just go right in on the screen, click once, and you're done. And we part as friends. So I hope to see you there. Check all that out, shadowtrader.net/options. And again, congrats to Andrew for being the winner of this week's Should I Do This Trade? As it is the eve of a FOMC announcement, which we're going to be getting next week at Wednesday, or on Wednesday rather, at 2 p.m. Eastern, I thought it was imperative that we do a Fed watch in today's program, and we look at what the odds are for a cut this meeting and the next. And then I also want to show you something that was on briefing.com this morning, where I get most of my news from. I've always said that I really love the way they very succinctly sort of encapsulate and crystallize what's really going on in the markets from a fundamental basis, which makes it easier to digest, I feel, especially in this particular environment, which has been a lot of cross currents of news. But let's get into these target rate probabilities for May 7th. This is what's happening next week on Wednesday. As you can see, there's clearly no appetite by the Fed for a cut as of now. It's less than a 3% chance, and there's over a 97.5%, almost 97.5% chance here that we stay the same. So the target rate is probably going to stay the same, which is the 4.25 to 4.5. Now, if we advance out here, excuse me, if we advance out here to June, you can see that the odds start to increase, but not by a lot. This is really something to watch, I think, very closely, especially after the meeting and obviously in the time period between May 7th and June 18th to see what happens news-wise, how the employment numbers are coming out, etc. Things like that that might nudge the Fed into this direction and get that 36.6% up higher than 50, 60, whatever, so there's better odds of a cut. And then if you recall, as I was talking about in the first segment when we looked at week in review, then you might want to be looking at favoring some of those small cap names or looking at utilities or things like that, things that are going to be anticipatory of that cut coming, and you start to see them rally ahead of that. So keep that in mind. But as of now, not a heck of a lot of appetite, I don't think, even in June. And I think all of this kind of makes sense because the Fed feels like it's on hold because of all the tariff news. And even though they do have data in hand in terms of what's going on employment-wise, et cetera, they don't have data in hand on what the effect of the tariffs is going to be, or whether or not the tariffs will end up being as large as they are now or not, right? We constantly get news almost every day of like, oh, China's coming to the table. No, they're not. Oh, they're here. No, they're not. Oh, they're going to be talking. No, we're not talking. So there's a lot of confusion out there. And I think that's one of the main reasons why the Fed wants to hold pat. They do not want to be cutting rates too quickly because inflation is still a thing. But more importantly, inflation has potential to get worse, right? With some of these, if these tariffs stay in place, et cetera. So kind of keep that in mind. So to that end, I wanted to just share with you one thing that came across the wires this morning. And this was the insight from briefing this morning, because we had some employment numbers this week. And notice what they were here. This is important. Job openings in March hit their second lowest level since 2020. Initial jobless claims, a leading indicator, rose above 240,000 for only the second time since July 2024. Private sector payrolls increased by the smallest amount of only 62,000 since July 2024. The employment index for the ISM manufacturing PMI posted its third consecutive month of contraction, and layoffs reached their highest total for the month of April in 5 years. All of that should point to a cut, but we're not getting it, right? But I think that's how the market is interpreting it, because it Of course, anything that points in that direction it sees as bullish. I like what they put here on the bottom here because, as I was saying before, I feel like they really put it together very succinctly, especially for individuals like myself who are not very fundamentally oriented. As you know, I'm looking only at the charts. So this is of help to people like me. And I quote, "The stock market rallied on the report, getting the best of both worlds. First, the employment report tempered recession concerns. And secondly, the report wasn't so strong as to make the market think that there won't be any rate cuts this year." So there it is in a nutshell. Basically, I think that lays it out pretty clearly, kind of both sides of the coin there. The Fed clearly, however, is in wait and see mode, and we shall see what happens next week when they have their meeting on Wednesday the 7th. Okay, time now for my number one draft pick. This is where I leave you with a good trade idea, a good chart, something I like for the next week or sometime thereafter in the show. This one for the music lovers, as I was saying in the intro, it is Spotify. And look at the chart here. It really is beautiful. There's a lot to like on this chart. Earnings are already in the rearview mirror, had them here. And look at this double bottom action here. Clear break in trend here. Right, break in trend here, kind of fell down here, then moving higher on the earnings, kind of gapped down and then rallied. I like that when it kind of loses footing on the report and then rallies all the way up. And most importantly, look where it stopped, right here at the prior high, right here, right? This is also mentioned a lot in IBD, Investors Business Daily. So if they like it, I like it, and it's looking pretty good. This way you want to play this is probably as a risk reversal. Obviously, you can just play the breakout with shares if you have a very long-term time frame outlook and just move up from here. But what I do is I like to look at this area here and assume that this is secure. So kind of how I look at it is that the trend line is law and prices will not go below this spot right here. So anything below that level, if you look at here, whatever that is, like if I move out like 3, 4, 5 days, what would be the end of next week, like May 9th, puts me at around the 600 to 590. So right in here is where I want to be shorting puts, right? I want to be minus puts here, preferably on a pullback. This is not the greatest location for put selling right now because the stock is so high, but if you fill in any of this area, I would say so. And then set up the call structure on the upside, which would be, we'll call that a plus C, being long calls. And that can be pretty much anything you want, like a 650, 675, call vertical, 650, 700. Could be a big butterfly, 650, 700, 750, like that, right? Like a 1-2-1. Any type of structure will work, but the starting point for the trade for me is to be short those puts somewhere in this area on minor pullback and making sure that the strike of the puts that I'm selling is below trend. Okay, as always, I leave you with a little bit of a calendar for next week, just so you have a good idea of what's coming down the pipe in terms of economic releases and also earnings reports. We're still hot and heavy in this earnings season, so there's obviously a lot going on. As always, I really only list a small smattering of the companies, ones that I like, ones that I would trade, some that I believe are going to have some effect on the market, basically. But obviously, this is not a comprehensive list. There's way more companies than this reporting. But let's get into economic data first. Relatively quiet week in that you got an ISM number on Monday, nothing on Tuesday, but this is the big one, obviously, right? As we were talking about earlier, that's the big one. And this is kind of big, too, the fact there'll be an initial claims number. Thursday is always payroll and employment and labor data day. It's always on Thursdays, and that's going to be important. But really, the focus in terms of economic data is going to be what happens on Wednesday, which we already know is not going to be any movement on rates. It's always all about the press conference and parsing the statement, et cetera, to give some sort of hint of what the Fed inclination is going to be going forward. But obviously, we know there's not going to be anything on the actual rate cutting front. As far as earnings are concerned, Ford Motor, Mattel in the toy space, Vertex Pharma, Williams is in the natural gas space, and maybe one to keep an eye on, just given those energy stocks have been kind of really, really weak. Palantir is reporting on Monday, and that's a big one. I'm trying to figure out if there's some sort of an options play, risk reversal for that it's safe. I'm generally not an earnings player, but this is a stock that I really like. And if you go back to the chart of Palantir, I didn't talk about it in today's show, but it's just like Spotify, it's retraced the whole move down. It's already back up at the highs at 125. And so I think there's a chance that coming at that level, they're going to report on Monday that it actually gaps up instead of down from there. I really wouldn't be surprised if the move up is going to be pretty, sharp, I would say. On Tuesday, we are going to get Ferrari and Sunoco and AMD in the chip space. I would say that one is probably quite important. EA in the gaming space, Rivian, another car making, Wynn in gambling and hotels, resorts, etc. Disney, somewhat of a bellwether, I think, for the economy. I'd be very interested to see what they say in terms of guidance going forward. That's probably going to be important. DoorDash and Zillow are also reporting that day. And on Thursday, we get KKD. That is now a very, very cheap stock, by the way. It's only like $4. But if you recall, it was a meme stock at one point, I think, before there were things like memes. And people just used to bull that thing up and down. So they are going to report on Thursday. Papa John's as well. I would pay attention to what they say in terms of how they feel about the consumer going forward. DraftKings and Microchip is also going to be reporting, and no action really to speak of on Friday. So that is our looking ahead for the week of May 5th to May 9th. And that is my show for today. Thank you as always for spending a little bit of your weekend with me. Recap a little bit of what we talked about, especially on the technical side. Probably one of the biggest monthly hammers of all time is printed in April. Is there history going back that shows that that shadow could get violated to the downside? Certainly there is, but usually it doesn't happen right away. And I also question if that can happen in the near future, given the sheer size and percentage move that we have now come off of that low. So keep that in mind. And speaking of those percentage terms, remember, we have now retraced more than 61.8% of the move from the all-time high to the recent lows. That is important. That tends to bode well for the buyers and usually increases the odds greatly that we will have 100% retracement from here on. So just also something to keep in mind, all right? Thanks again to Andrew for giving us that idea in Google. That's working out quite well. And also Spotify is the #1 draft pick this week. So watch that one for a setup, as I talked about, potentially selling some puts ahead of that trend line support and looking for a move up above that 650, all right? If you can, please hit the like and subscribe buttons. We are like this far away from crossing the 100,000 subscriber mark. I'm super psyched about that. Hopefully we will do it this week. If you are not yet subscribed to this channel, please help us out. Hit that subscribe button and also the little bell icon so you can be notified whenever Shadow Trader posts new videos, which of course is every day through our Shadow Shorts program, where myself and my entire team from Live Trading Suite put out short 3 to 5 minute videos every single night, and they are free. If you're interested in that, just sign up at the homepage at shadowtrader.net. All right, I'll see you next week. Be careful out there. As always, I wish you good trading and good night.